Welcome to the Multifamily Dispatch. I'm Dan Gable, and I'm joined by Dr. Matt Bastnagel. As always, Matt, I am happy to be back. You and Kevin and Nick did an awesome job while I was out. What are we going to do today?
Oh, well, thanks. I've been singing the praises of last week's co-hosts, Nick McCracken and Kevin Burns as well, but I'm glad you're back, Dan. You're the best. This week, we've got some cautiously hopeful signs from the apartment market, from consumer sentiment, and from the broader economy. Cautiously optimistic, my favorite kind of optimistic. Let's get started with an update on the apartment market. So I was waiting anxiously for this month's apartment list report to lend some clarity to an uncertain, muddled year for multifamily fundamentals. The apartment supply wave has peaked, but it's not quite over yet. And apartment performance has continued to be lower than historical averages. And that's something that's probably blatantly obvious for operators across the country. Doesn't really matter where you are. It's not as good as it once was historically. There is regional variation, but like I said, the top performing regions and markets are lower than you would expect in a typical market, or at least one that isn't so supply heavy. It's hard for me to even say typical market now because the last, for the better part of 10 years has been up and down, and there's been no real normal for any 3-year stretch. But I'm looking forward to that. I'm hoping that that's going to be the case. But if there has been any pattern, it has been this muddling through that likely 2026 will be a lot like the years past. So that kind of that's a little bit of a spoiler. But I've got some numbers to back it up. Year over year rent growth went up from negative 1.4% to negative 1.2%. And monthly rent growth is down from positive 0.6% to 0.4%. Last June, so a year ago, monthly rent growth was 0.2%. So this year, the June rent growth is better. Also last year, rent growth peaked in March, and this year, maybe it peaked in May. So pre-pandemic 2029 also peaked in May. So this is a lot closer seasonally, the rent growth patterns compared to previous years when rent growth peaked much earlier, a couple months. This shift, this pushing the peak rental season forward 2 months, it could also be a sign that the apartment market is less and less dominated by the enormous supply wave that hit several years ago. But the lower rent growth in general suggests that nationally, the multifamily market is still adjusting to all these new apartment buildings pushing down the rents. So that's kind of the summation of the rent growth story. And apartment list highlights the decline in vacancy as a sign that we're digging our way out of that slump in the apartment market. Since bottoming out at 3.8% in October 2021, vacancy rates had steadily and consistently risen until basically February of this year, when it was at 7.3%. And since then, vacancy has very gradually ticked down to 7.2%. It's like 0.4 or 4 basis points every month. So very slow, not much of a difference, but this little dip in vacancy is the biggest we've seen in 4.5 years. And it hasn't gone up in the past few months. So that dip has some staying power, as small as it is. The way that they're measuring it on apartment list, the vacancy rate's not that volatile. It doesn't really go up and down that much. So there is some reason to believe that that vacancy is improving in like a very, kind of building momentum.
We're on a positive trend.
Yes, exactly. That's a better way of putting it. It's a slow shift, this adjustment and balancing of the apartment market away from the higher supply that we've seen in the past. But it is happening. That would be that's kind of the takeaway that I've gotten from all the articles here is that we are making slow improvements. There's in some articles, they say it's less bad. It's not maybe better, but it's less bad. I think it is getting better no matter how you look at it, but it is a small increment and it still means that challenges will persist. So yes, the Midwest and Northeast are clearly doing better than the South regionally, but no matter what region you're looking at, rent growth is low. The small signs of improvement are encouraging. They don't erase those day-to-day challenges that apartment operators continue to face. 2026 may end up a little bit better than 2025 or 2024, depending on how these next 2 months go. But more likely or not, this year is going to be a lot closer to the past few years than it is to kind of a recovery year or one where it's obvious that things are going a little bit more evenly with supply and demand. Dan, when it comes to apartment operations, is there an area that's gotten less difficult in 2026 than years past?
No.
Okay.
No, but we love it. That's
Yeah.
why we love it. It's a challenge.
Yeah, yeah, and this is, and that was the other takeaway too. It's, and I know I kind of facetiously said cautiously optimistic, my favorite kind of optimistic, but it's an optimism that involves work, and it's one that makes sense. Like, you have to work hard in order to succeed in the apartment industry. It's not going to be an easy dollar, and you'll see the deals that were made when people thought it was an easy dollar, like in 2021 and 2022. Those may be kind of coming back, and we're realizing, oh wait, no, it wasn't that easy. I've got to pay the piper, the lender. So as we mentioned previously on the multifamily dispatch, apartment list tends to have that lower estimate on rent growth compared to other data sources, and other sources tend to interpret that data in a way that's maybe more palatable to investors. Admittedly, I do try to do this on the multifamily dispatch. Trying to find the positive productive decisions that can be made is not a futile exercise in a market as varied as multifamily. There's always going to be a good decision that you can make, and I would even hesitate to call it the best of worst decisions. I think that there are better decisions and there are better things in the market. You just have to work for them.
Yep.
But some people are a little bit more on the sunny side of things, and I think that would be the Marcus and Millichap angle. They're a little more optimistic here in this brief report. The subtitle is "The Fundamentals Hold Firm Despite Headwinds, Keeping Investors Engaged but Selective." So it's a brief 4-page report. It's their Q2 national report on multifamily, and they're more optimistic, like I said. Cap rates are up 10 basis points since last year, but they call it stability. Increasing debt pressures are framed as a support for continued apartment demand. So like people that would get mortgages are now going to be renters. But I have some doubts about that as a huge driver of demand. They have a higher rent growth number, 1.5% than apartment lists as well. And they report increased multifamily sales activity in Q1, but good for them to kind of note that the Iran war has likely moderated sales activity compared to last year.
Yeah, just increased uncertainty.
Yeah, so increased uncertainty for sure. I think so. Other findings here, like the 25% increase in tertiary market sales activity and the 33% increase in Class B trades, are interesting signs of an investment market looking for value and returns outside of typical areas like the Sun Belt. I'm waiting for when selective. So what did they? Sorry, the title, right? Did I say the title? Investors are engaged but selective. I think that selective, I'm waiting for when that means Midwest. And in this report, it just means non-Sun Belt. They're so close. They are so close to pulling off the blinders and seeing the bright Midwestern sunshine. One of the shining right now, but they can't quite do it. Non-Sun Belt it is, I guess. And Newmark does this too. Their report has a little dot graph that's color-coded by gateway, Sun Belt, and a non-Sun Belt. Actually,
I don't even think they call it non-Sun Belt. I think they just call it other.
Oh, great. Other. Well, that's what I just ran across this map. And for the listeners, it is a map where the United States of America is highlighted. That's just all the Sun Belt states. And then above that is a grayed out area of the map where it says unknown states potentially in the U.S., but not really worth checking. And that's the vibe I get from some of these reports. Non-Sun Belt, ignore it. That's fine. But it is true, though, that it's reflective of investor interest. Investor interest is relatively more concentrated in the Sun Belt, and I would say like in the South census region specifically, and that's where a lot of the population is, a lot of the population growth. Of course, there's going to be attention paid to it, but I think they need to be a little bit more realistic and stop saying things like, "Oh yeah, the recovery is right on the way." Like in the Marcus and Millichap, they note the increasing affordability of Sun Belt markets. But they kind of pick and choose a little bit of their markets here. Like they're comparing Phoenix and Austin, which admittedly they got a lot more affordable because they built more apartments, but they're comparing it to Chicago, and that's an unfair comparison. Chicago and New York. Well, how about you compare it to Indianapolis, Columbus, Cincinnati, real actual Midwestern cities that do exist. But maybe they don't, because I looking at this map again, it's not really worth
You don't
checking.
see them in there.
Yeah, it's not really worth checking. Yeah. So, yes, it's clear that Sun Belt performance is not there yet. And while it's true that apartments have become way more affordable in the Sun Belt, they don't always compare favorably to affordability in markets in the Midwest. They don't mention interest rates necessarily as a drag on on multifamily investment in this report. And instead, like I mentioned before, they've kind of framed the interest rate issue as either supporting apartment demand from would-be home buyers, or rates are range limited and not going to jump up too high. I like the reassuring tone here. It makes it feel better. But maybe, Dan, we should all stop worrying and learn to love high rates.
I think you're right.
Good.
I think you're right. No, Matt, for the last several years, most of the multifamily commentary has been basically the same. Like, hey, when are rates going to come down? When's the Fed going to cut? When do we get, magically get relief of these from these over leveraged deals from 2021 so that they'll pencil again? What if I told you that lower interest rates means lower real estate returns?
I don't believe you.
Well, that is what this study from Newmark suggests. The title of this report is CRE Returns in a New Rate Regime. Cheering for rate cuts is cheering for lower returns. Their research found that multifamily investment actually performs best during periods of stable rates, not during rate cutting cycles. The headline of this article does its job grabbing attention, but the real takeaway from this report is it's not about interest rates at all. It is a bigger story, and it is about U.S. demographics, and about how the U.S. has entered this demographic era where virtually no job growth is needed to maintain full employment.
Yep.
So we're seeing this in real time. The U.S. employment report for June came out today, Thursday, July 2nd.
Yeah.
And despite missing projections and only adding an estimated 57,000 jobs, the unemployment rate actually went down.
Yeah. Weird.
Yeah, weird. So we're going to pull up this graph from the Federal Reserve that's in this report here. It shows, estimated break-even employment growth. And if you can see the far right of the graph, it is basically zero. So this means that in order to maintain a steady unemployment rate, we don't need to add any jobs. So any jobs that we add will continue reducing the unemployment rate.
What's interesting, and you noted the demographic thing, is it looks like the trend started before the current Trump administration. In Biden's administration. So that suggests it's not necessarily all immigration. It's a demographic thing.
Certainly. That's right. You've got a huge generation, the boomers, who are leaving the workforce, and you have lower household formation among younger generations. Yeah. So we do have kind of this demographic bubble that's formed.
We talked about that last week. It's a little bit troubling to think about how, whether it's demographics or immigration, the combined force is like population growth has never been this low, and it's scary and new, and I don't like it.
Well, what we're going to have to do is grow our way out of it through productivity.
Okay.
Right. So, this may be one of the biggest underreported stories in multifamily.
Yeah.
So for decades, investors and lenders have used job growth as a shorthand for apartment demand. Well, if job growth naturally trends to zero, but employment remains high, then this metric becomes less useful, right?
Yeah.
A metro adding only 1,000 jobs may not be weak anymore, and a metro adding no jobs may not be in recession anymore. The central argument in this research is that future GDP growth will come from productivity gains rather than employment growth.
Okay.
So glad that AI came on the scene just in time.
I guess so.
What this means for us is that, as multifamily investors, we need to adjust kind of how we think about demand, rent growth, market selection, and long-term returns. So assuming all this holds, this means that multifamily investors adjusting their thinking about markets, maybe in an environment where high job growth is needed to sustain full employment, investors would naturally go to areas with high population growth, high household growth, high job growth, right?
Yeah.
Well, in this new kind of regime, by the way, that sounds a lot like the Sun Belt 5 years ago.
Yeah. They're going to recover. They're recovering already. I just know it.
They are. But, in this new regime, perhaps we should be looking at markets where household income is growing, but maybe not too fast. Places where workforce quality continues to improve and supply remains disciplined.
Yeah,
right.
Yeah.
So the Sun Belt's dominance was built on migration, population growth, household formation, etc. But if demographic growth slows, then the competitive advantage really, in my opinion, shifts toward markets that are affordable, markets where there's economic productivity, pro-business, and most importantly, supply discipline.
Yeah.
So markets where you don't see rent growth that's so hot that's encouraging lots of new development, right? Slow and steady.
Yeah.
That sounds a lot like the Midwest to me.
Yeah.
So I think this article and this research really supports something that the Multifamily Dispatch has been saying for, repeatedly. And that's something that we at J&G companies have been focused on. And that's the next decade may be less about chasing migration and more about identifying durable and stable income growth.
Yeah.
Right.
Interesting.
Yeah. So what happens if this supposed productivity does not increase? And AI doesn't supercharge every worker. Well, that means lower GDP, which means lower economic growth, which means lower wage growth, which means lower income growth and stagnation.
Yeah.
Right. Which means in order to protect the downside, we want to look for deals with good in-place cash flow today, where we can leverage our operations team to provide best-in-class service to our residents. I think the biggest takeaway from this whole report and this whole paper is that multifamily investors have spent 20 years benefiting from two tailwinds at the same time, historically low interest rates and growing populations. This report argues that both of those are disappearing, which means the winners in this next cycle, will be the ones who find the most durable, the most steady cash flow, and those who can operate efficiently at a high level.
Okay. I think that it is a little bit of an indirect argument that they make when they're talking about rate cuts equaling lower returns. If it checks out historically, that does make sense. I can't disagree with that. But I also think, like, individually, can't we just time it right and just ride that wave? But I understand, like, this is a little bit of a be careful what you wish for. Where if we do have low rates, it's because the economy is going to doing bad. I will, just to follow up on the population growth. It is a little bit of it's a reality check for places that were depending on population growth. And if you see some place with high job growth, then does that translate into more household growth rather than population growth? Is that kind of what the argument is?
It's just that the two and two went hand in hand.
Yeah.
Right. Well, if you stop population growth, then you've stopped job growth.
Yeah.
And somehow we have to have growth in the economy. So if we don't have
kind of like income growth.
Yeah. So an income growth, but also just economic growth, right? More opportunity, higher GDP.
Yeah.
So if job growth is not driving GDP, then something has to.
Yeah. Okay.
Right. And the only thing that's left in that equation is productivity.
Got it.
Which means that in the absence of new jobs and more jobs, the existing workers have to become more productive in order to drive growth in revenue.
Yeah.
Right?
Yeah. So I'm just trying to understand this from, like, I'm trying to fill apartments with renters and trying to improve my NOI. Is if the renters are making more, then
you can charge more rent.
Then you could basically charge more. Okay, so that's kind of what you would look for as a lever, rather than rather than people counting on more renters moving in. Maybe it's going to be more of an issue of the renters have more money, and that's what's going to drive it.
Yeah.
Okay.
Yeah.
Interesting. Yeah. So I'm not really ready to throw caution to the wind just yet. And I don't think neither it seems our consumers. And new consumer sentiment numbers are out there from the Conference Board and the University of Michigan, demonstrating that whatever recovery and revival we'll see in economic sentiment is going to take some time to develop. Now, the demographic changes that you noted are also slow moving. We see it coming, and it's not going to be a surprise to anyone. And right now, still, we're in this kind of supply dominated situation that has still yet to play out. So there's time for people to react. And this reaction that we're getting happening in economic sentiment is also kind of a slow moving situation where we're not going to see things improve all of a sudden. It's just going to be a slow, gradual, hopefully consistent trend upward.
Mm-hmm.
So yes, this is a very quick vibe check with new data from both the Conference Board and the University of Michigan showing a slight improvement in consumers' attitude about the economy. From the Conference Board, they have consumer confidence up from 90.6 to 91.2, and from the University of Michigan, consumer sentiment is up from 44.8 to 49.5. Both sources, an improvement. I'll take it. And I like it because there is consensus there. Sometimes, and it's usually actually the University of Michigan will have maybe a dip while the Conference Board will have an increase, but this time we get them both, so I'm convinced. So let's do inflation now. The Conference Board median inflation expectations for the next year are down from around 5.25% to 5%. Great. And from the University of Michigan, they're down from 4.8% to 4.6%. Like I mentioned before, the consensus from these sources is that we're doing less bad. The Conference Board notes that the write-in comments skew towards pessimism, and the University of Michigan also says that we're still in unfavorable territory, with sentiment 13% lower now than it was in February. My initial assumption then was to think that this could potentially be a more positive development than simply less bad, because we've got both data sources agreeing that things are improving. Mm-hmm. And this is the first time we've seen an increase in University of Michigan consumer sentiment this year. So positive trends have to start somewhere. I'm ready to be optimistic. Maybe they'll hire me in Marcus and Millichap. But I do still think that this is a positive development in consumer sentiment. Still, though, there are other data points here that show that consumers aren't just uniformly feeling better about every single part of their economic situation. So when you talk about the Conference Board, the confidence in families' current financial situation is equal for the first time since August of 2022. This is kind of a unique crossover moment.
Does that mean that like half feel like things are getting better and half feel like things are getting worse?
Yeah, but the numbers don't add up that way on the chart, and I'm not getting the full numbers because you got to pay for it. But the suggestion is that, like, I am assuming that right now half think it's the same, 25% think that their financial current situation is doing good, and 25% think that it's doing bad. Mm-hmm. The reason why it's notable that it's all the same is that since August of 2022. People were more likely thinking that they were doing good than doing bad. And the trend here is towards the family's current financial situation being worse than it is better.
How strange. Yeah. So this piece of the report shows kind of a decrease in sentiment.
Yeah.
But the overall
overall is fine. Okay. I think that it's the difference between how they think their family's doing, how they think the economy's doing. Yeah. People are very generous. Maybe they look around and see other people doing well, and they're like, all right, well, I guess it's doing fine for some people. Yeah. That's my own like implication there. And I may have this written down in the notes or not. The University of Michigan has one of the pullout data for this month was they have data on how much stocks do you own, and the people that own stocks are a lot more optimistic than the people that don't own stocks. That's usual, but the gap is a lot wider now than it was like pre-pandemic. And
between those who own and those who don't?
Yeah, exactly. Those who own stocks, the top people that top quintile or quartile, whatever, they have they're really optimistic in a way that's that's a little bit skewed.
Interesting.
Yeah. And I looked in the past because it's typically about 4 to 8, 5 to 8% is the stock owners are more optimistic. And now we're at like 14%. So There's a big gap there. Yeah. Also from the University of Michigan, household situation is getting worse. It's down from 67 to 58%. Think that they're doing worse than a year ago. Business conditions are down from 36% to 33%, and job expectations are roughly flat. And then finally, the labor market vibes are a little bit down from the Conference Board. They're going from 16.6 expecting new jobs, expecting more jobs to 15.2% expecting more jobs, but maybe we don't need those new jobs too, like you've highlighted it from the recent jobs report. And I have a note here about a recent ADP jobs report was under expectations. That's old news. You got the official numbers and they're also under the expectations, but unemployment's down. It's going to take me a little bit of time. I'm sure like all the other financial reporters are going to have some time like having to kind of understand this and before it kind of seeps into the understanding. But I do think, you can search in the crosstabs all you want for little spots of optimism and pessimism. But in general, there is a glimmer of hope here. Sentiment isn't falling, but it's clear that it's not going to jump up into total economic happiness anytime soon. There's more work to be done and more time really to do that work before things can improve in earnest. But I think, like you said, we like the work. It's good.
That's right.
Yes, so the apartment market needs some work, needs some time to improve, but it's making some gradual progress. And of course, we're making progress and doing the work here every week on the Multifamily Dispatch podcast and the Multifamily Dispatch newsletter, which you can subscribe to at www.themultifamilydispatch.com. Dan, I think we did it again.
We did it. So, Matt, markets change, demographics change, sentiments change, rate cycles change, challenges change. But as we head into this Independence Day weekend, what remains the same is the ability of Americans to adapt, to innovate, to be optimistic, to move forward through resilience and that optimism, continuing to form a more perfect union. From all of us at J&G Companies and the Multifamily Dispatch, happy Independence Day. Have fun, be safe, and we'll see you next time.